Hello and welcome to the end of May update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to help and maintain investment health. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and implement each month, for those of you who are new to the book, or for those of you who are new to investing in general, feel free to follow along every month until you get the hang of it. So this month's video, we'll start with the question or topic of the month, and then we'll go on to review our systems, namely our 20-month simple moving average system, review the MRI adjustment of the month, and then again just touch base on the 25% trailing stop loss system for those of you who insist on investing in individual stocks with their idiosyncratic risks. So the topic of the month, last month we were talking about dealing with loans. And I was very surprised. I originally made that video more for the residents, but I've gotten a lot of positive feedback, not just from residents, and I guess this is a very topical topic. We first started questioning how do you build wealth while still dealing with loans. And we started talking about the differences between using lump sum payment versus drawing out payments with interest over time, even when payments are larger than our savings rate. So, worst case scenario is what would happen if we were to retire with no more wage income, no more income from traditional sense of trading time for money. We would be totally dependent on just income from whatever investments that we have or whatever strategies we're using, or if you believe that government still be solvent by the time we get to retirement age, whatever the government can give us. Well, let's go back to our example again. So let's say we were saving $1,000 a year at 8% a year. What happens if at the 15th year we find a $29,000 something that we really have to buy, either a large purchase or college or something that we need to buy? Well, if we were to just lump sum buy the whole thing with whatever was in our account and go down to zero, well, it would take another 15 years to go back to 29,000. Meanwhile, if we instead left money alone in our investment account to grow for the next 15 years, we would have made 122,000, or almost 4 times more than what we would have had if we just used a lump sum money to buy it. But wait, what if that 29,000 whatever we need to buy was a necessary something? Well, what would be the difference if we just bought everything in cash versus taking out a loan at 14% and stretching out the payments over 15 years? Well, with this example, we would end up with 29,000 at the end of 15 more years. With this particular example, even though saving 1,000 per year, we're actually paying 2,600 per year to service this debt, we would still end up with more at the end. Well, that's interesting. We are spending more than we make, and yet we still make more. But remember, this is a very simplistic example. We're assuming a smooth 8% growth per year while we're invested. And we know that in the investing world, nothing is ever that simple. In fact, markets go up and markets go down. So let's take an example here where we have two people, Connie and Daphne. They're both 64. They both have $500,000 in their accounts. Now, in Connie, she lives in this world where the stock markets go down, go up, go down, go up, go down, go up. And finally, at the end, the annualized return is 8.03%. Not bad. Just like in our example. Daphne, on the other hand, let's take the order of returns per year and just flip it over. So instead of year 25, we make 12.78%. Year 1, we make 12.78%. Instead of year 1 losing 10.14%, year 25 lose 10.14%. Well, what would happen if we were to take this hypothetical $500,000, take out 5% of it, and then every year after that, take out that same amount indexed for inflation, assuming 3% inflation. So every year take out a little bit more, every year take out a little bit more. You can already see, just by looking at the withdrawal rates, that over 25 years with 3% inflation, we would need to take out more than twice as much as we did in the first year just to have the same purchasing power. That's the risk of inflation. But now, what would happen if we factor in market returns? When the markets go down, we take out that percentage. Markets do whatever it does, take out more. Market does whatever it does, we take out more. By the end of 20 years, Connie's broke. She's 85, she's broke, she can't make any more money, she's in a bad position. Daphne, on the other hand, same returns, different order, keeps taking out the exact same amount every year as Connie does, only now, at the end of 25 years, instead of being broke, she actually has $1.6 million in her account. Connie took out $685,000 over a lifetime and ended up broke. Daphne took out $911,000 over her 25-year lifetime, and she still had a balance at the end. This is what we call sequence risk. The sequence of returns can make a huge, profound difference in what we end up with when we start withdrawing. Now, obviously, in retirement, there are more risks than just inflation risk and sequence risk. We haven't even mentioned, just because we have loss of income, accumulation versus distribution rates. We haven't even touched taxes or increasing costs from healthcare or other emergencies. But this is why we need a plan way before we get to retirement. So again, for those of you who haven't even thought of retirement and you're already my age, I'm not going to embarrass you by telling you how old you are, really need to look at some of these things. So again, save and invest are priorities, but wait a minute. Some of you have come to me and said, well, I've spent so much already and now I have such low balances in my retirement accounts. What gives? Well, remember, there are some pundits who say, don't drink your lattes. In other words, if you were to drink a latte per day, and instead of drinking that latte per day, you were to save and invest in your retirement account instead, you would have a lot more in your retirement. That's true. But then again, what's the whole point of earning money? We have fruits of our labors that we should be able to enjoy now as well as later. Where's the balance in that? Well, stick around. Next month, I'll touch base on that as well. Meanwhile, let's get into our systems. So our first system we'll get into is our 20-month simple moving average system. The rules of the game is you take the 20-month moving average. In other words, the last 20-month average price of the S&P 500 index. You calculate it out. If the index is above the moving average price of that month, it's relatively safe to stay in the markets. Otherwise, get out. The 20-month moving average is our safety belt. So how did it work this past month? The VFI index, which is the index fund I use that tracks the S&P 500 index, I use just because it has so much more data for me to calculate. It ended end of May with $194.10 per share. The 20-month moving average is $186.85. So the final price is above the 20-month moving average price. For this month, it's relatively safe to stay in the stock markets. So the next system is the monthly rotation investment system, the MRI system. It's a completely different system. Again, for those of you who are new, don't get these mixed up. You're using one of the same funds, the VFI Index, the S&P 500 Index Fund, but we're doing something different with it. What we're doing is we're taking three funds, this S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse Fund. Every month we're ranking to see which one did the best. Whichever one we did the best, we sell the bottom 25% of our portfolio and buy the top fund. So what do we do this month? Comparing last month's prices to this month's prices, we see that the S&P 500 index actually gained almost 2%. Here we go. Meanwhile, the inverse fund, the green fund, went down almost 2%. And the emerging markets fund went down more than 3%. So this month we have a clear winner, the S&P 500 Index Fund. So what do? Last month we were roughly half in the emerging markets fund and half in the S&P 500 Index Fund. If we were to sell the bottom 25% of our portfolio, we'll be selling 25% of our portfolio worth of the Emerging Markets Fund to buy the Index Fund. So what we would end up with is roughly 25% Emerging Markets and roughly 75% Index Fund. Next system, again, is a completely different system. It's a system that we use if you insist on buying an individual stock. And remember, individual stocks have different risk to consider when you invest. So, if you want to make sure that you never risk more than 1% of your portfolio on any one stock, you can buy up to 4% of your trading account of that one stock and immediately enter a 25% trailing stop loss order. This way, if the stock goes down 25%, you're out, you only lose 1%. But if the stock goes up 33%, now the stop loss is essentially at where you first bought the stock. Remember, when the stock goes down 25%, you have to make 33% just to break even. The corollary is true. If it goes up 33%, that means you have a 25% cushion until you break even. So when the stock goes up 33%, buy another block of stock using another 4% of your account and repeat until you're stopped out. So in summary, there are different systems. Don't mix up the systems. If you use rules for one, don't use the same rules for another. If you mix up systems, you no longer have a system. Remember, you have three systems: the 20-month moving average system, the monthly rotation investment system, and glossed over the basics of dealing with stock tips using that 25% trailing stop loss system. So questions, keep them coming. I know I talk to several of you personally every month, but for those of you who have only heard of me indirectly, maybe a well-meaning colleague sent you a copy of the video, here are ways to get in touch with me. Seriously, drop me a line, send me an email, give me a call, set up an appointment, let's talk. A few of you I've talked to, you know your stuff, you're fine, I don't worry about you. But some of you, holy cow, it's clear you need help getting your financial life in order. So don't be bashful reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.